Welcome to our Taking Stock video for the week ending the 15th of December 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. Great to have you on board again.
Yeah, it's good to be joining you once again. Thanks, Kieran.
And I'm just unbelievable. The year has passed so quickly, Matt. But before we get started, just a quick yet important reminder. The information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shown today shouldn't be relied upon as a guide for future performance. And talking about performance, Matt, both the US and Australian markets continued its winning streak this week as investors became increasingly optimistic that the interest rate cycle has reached a peak. During its Fed meeting, Jerome Powell kept interest rates on hold and alluded to the prospect of 3 rate cuts next year. This came on the back of the US CPI print for November, which showed that the annual inflation rate slipped by about 3.1% in November, and that's down from 3.2%. Locally, though, bond markets here have brought forward their expectations on when the RBA will cut their rates. And as you can see from the chart on screen, markets are projecting that rate cuts will begin to occur in the first half of 2024. This is in stark contrast to expectations last month, which suggested that there's a possibility of a rate rise in March early next year.
Yeah, Keen, it certainly feels like the pendulum has swung from extreme bearishness only a few weeks ago towards the end of October. And in this very short space of time, investors are again throwing caution to the wind and buying up risk assets. And this point can be no better expressed, I think, than the rapid snapback in junk like unprofitable tech stocks on the NASDAQ and even cryptocurrency. Yes, the same asset class where its most prominent ambassadors like Sam Bankman-Fried are awaiting criminal sentencing for fraud. And although markets are behaving as though we've achieved a soft landing, we need to take a deep breath because we're not out of the woods yet. Inflation is still well above target and restrictive interest rates are likely going to weigh on economic growth into 2024.
Yeah, that sounds about right, Matt, especially core inflation, which excludes food and energy costs. It's actually rose by about 0.3% in November. And that's translating to an annual inflation rate of around 4%, unchanged from the previous month and still twice above the Fed's target rate of around 2%. When you look at services inflation, that remains quite sticky, and that's driven by higher wages, rents, and the low unemployment rate as well at 3.7% in the US. So it does appear too early to believe that the inflation fight is over here.
And what's most concerning, I think, taking that into account, Ken, is the S&P's hit near enough to its all-time highs into a period where it is quite possible that we're going to move into an economic contraction in 2024. So we feel as though analysts are a bit too optimistic on earnings expectations into this particular period. And although a soft landing is plausible, if you take into account historical context, there are many lanes that the global economy can actually go down. Remember that the path to recession will look eerily similar to that of a soft landing and that both scenarios require a slowing of the economy. So whilst the market is celebrating softening economic data at the moment, recall last week that the Aussie GDP was well below expectations. Our approach is to progress with some caution and advise those that are getting carried away to be careful of what you wish for. Poor economic data will eventually manifest in earnings downgrades. So until we get more clarity in the direction we're heading in, we'll continue to reduce the market risk within our managed fund portfolios and save our unit holders from the wild volatility that we're expecting ahead of us.
Thanks, Matt, for that. On to some company news this week. Salary packaging and fleet management firm and Star Growth stock and Star Income stock, McMillan Shakespeare, they lost a salary packaging and novated leasing contract with the South Australian government to rival Smart Group during the week.
Yeah, that's right, Keen. And while McMillan management were tight-lipped around the factors that may have prompted the South Australian government to switch providers, it is typically based around who can offer a sharper deal. And I recall a similar situation when Smart Group lost a major contract in Victoria to McMillan in 2022. Smart Group and McMillan are the two largest players in this space, so it's not unreasonable to see contract switches from time to time.
And from Jason's commentary, though, we do understand that the contract loss represents about a 5% impact to financial year 23 earnings. Given that the stock has experienced strong earnings revisions over the last 3 months, this news should only take earnings expectations back a few months. So I guess this is why the share price recovered from the initial negative reaction.
Yeah, correct, Ken. And also in the headlines this week is a potential tie-up with energy players Woodside and Santos. Jace has written an in-depth review on the benefits and risks of the merger, which is currently a feature article on our Insights panel. Now, if you want to receive these articles, you can update your notification settings found on the top right of the screen under your name. And on the topic of M&A, there was another tie-up announced this week between Chemist Warehouse and Sigma Healthcare. The backdoor listing was well received, with the stock rising by over 40%. Ken, what are the analysts' thoughts on this one?
Yeah, interesting question, Matt. We haven't really run our ruler over the deal yet, but most fund managers and investors have been positive on the listing. Sigma Healthcare currently fails our financial health model because its earnings have been rather volatile. The irony here is that recent performance may have been caused by Chemist Warehouse pulling its supply contract from Sigma in 2018.
Yeah, there's certainly a lot of detail to digest here, and our only advice to members is to spend a bit of time on understanding Chemist Warehouse and its business structure. The pharmacy segment is highly regulated, and Chemist Warehouse's ability to consolidate a sizable part of the market is certainly quite unique. So our analyst on this one, Jason Yoon, is currently running the numbers and should provide some more insight very, very soon.
And looking ahead, Matt, in the corporate calendar, it's going to be a relatively quiet week as the year winds down. But we do remind investors that many REITs are expected to go ex-dividend at the end of the month. In Under the Microscope this week, we take a deeper dive into recent borderline style growth stock addition, Mineral Resources. Our investment thesis is premised on the fact that the market is viewing Mineral Resources as simply a lithium business and has sold it down in line with its peers. However, its business is more diversified across iron ore, mining services, and also it has energy market potential.
Yeah, that's true, Ken. And as you can see on screen here, that the lithium price decline is the major cause of the recent earnings revisions, which is impacting share price sentiment, obviously. But Dan has pointed out the FY23 group earnings were 70% derived from lithium, but that was more a function of the record price environment previously. And over time, we anticipate that this segment will move closer to about 40%, as there will be greater contributions from the mining services division.
Yeah, and I notice iron ore prices have been quite elevated as of late, but under Golden Rule 3, also free cash flow is significantly negative as well. But I don't think this is too concerning, given that the business is ramping up its expenditure at its game-changing Onslow iron ore project. So I guess, Matt, does this stock represent a long-term opportunity for investors?
Good question. Look, with the outlook expected to improve into FY25, long-term investors may see the share price weakness as a good opportunity for entry. However, investors will need to be mindful that the outlook is driven by commodity price assumptions, which we all know are quite volatile. So before making an investment, members should be comfortable with the active risks. For instance, Dan clearly articulates that the significant capital expenditure will mean that the company needs to take on further debt.
Yes, Matt, and this could change the financial health profile of the business. So we will be monitoring this business very closely. And under Golden Rule 4, we noticed that it is trading still below the SD30 TSR. And so trend-sensitive investors should remain on the sidelines until the stock signals a re-entry on that indicator, the SD30 TSR.
So we have quite a few lithium exposures now, don't we, within our star stock universe, and you can compare them in the peer review table. So I guess with that said, does Dan have any real preferences in this space, Ken?
Good point, Matt. From a fundamental perspective, Dan has previously mentioned that his preference is for Pilbara Minerals, which currently has the highest return on invested capital. His second pick would be Mineral Resources, but in contrast, though, his least preferred currently is IGO because it's dealing with the issues in its nickel business, which could be an overhang to the share price in the short term.
Yes, shorter term maybe, but regardless of order of preference, we do believe that all these exposures do represent long-term shareholder value.
And with the markets pricing in a peak in the interest rate cycle, a useful question for members this week is, what star stocks and sectors are beneficiaries of lower interest rate expectations? Well, Matt, the answer here is not that straightforward, is it? Because falling interest rate expectations, in this case, also corresponds to slower economic growth, which makes it more difficult for most companies to generate profits. Hence, ideally, you want to look for companies with strong market positions, a large profit margin, and strong financial health with a defensive earnings profile.
And a continued decline in bond yields will benefit some of our companies with those higher debt levels. Stocks in this space include property trusts, utilities, and infrastructure. And from our star stock universe, within this group, you've got Telstra, Spark New Zealand, Arena REIT, Charter Hall Social Infrastructure, BWP Trust, Charter Hall Long WALE, and APA Group.
Yeah, we've begun to see some of those what we call bond proxies recover. Also, the quality growth companies in the technology sectors should also perform well. And that's due to their point of differentiation, high reoccurring revenue and subscription models. Star stocks here include WiseTech, Altium, Hansen, and Objective Corp. Meanwhile, healthcare stocks like Pro Medicus, CSL, ResMed, and Cochlear should also do quite well.
And within that retail space, although low interest rates could lead to a rise in discretionary spending, that could be tempered with slower economic growth, and that lagging impact of recent rate rises could offset much of this benefit. So rather than playing within that space too deeply, it's probably best to stick with the consumer staples where cash flows are far more defensive. So stocks in our universe would include Woolworths, Coles, and Endeavour Group.
And last but not least, falling interest rate expectations can benefit gold stocks, Matt, especially if inflation remains sticky. And those on this list of our star stocks include Gold Road Resources, Perseus Mining, Capricorn Metals, and Alkane Resources. Well, that's all we have time for today. Appreciate your contributions, Matt. Very valuable for our members.
Thank you, Ken. It's my pleasure as always.
Also, if you have any friends or family who you believe will benefit from Stock Doctor and our insights, feel free to invite them to come on board, especially during this period where they can benefit from our attractive Christmas promotion. Finally, a reminder that our Lincoln Live webinar, our last one for the year, is on Monday. So please come along to our webinar to ask our panel of experts on stocks, portfolio strategy, or how to use Stock Doctor. So to summarize today, market is pricing in the peak in interest rates, but investors need to be wary that falling interest rate expectations also correspond to weaker economic conditions. Hence, stick to those high quality, financially healthy businesses. Take care and have a happy, healthy, and prosperous week ahead.